Well, welcome everybody. It's such an honor and a privilege to be able to do this with you and for you. And we really take our mission seriously about educating you, empowering you around your finances, helping you to create peace around the issue of money. I'm Brad Lineberger, president of Seaside Wealth Management, and with me today is Matt Callahan, certified financial planner. And we are going to take you through a mid-year review 2022. Before we launch in, I just want to give kind of a shout out here to Matt. He's officially, not only is he a certified financial planner, he's officially a retirement income planning professional, an RICP, and he spent the last year studying for this. So he's an expert in how to take out retirement income distributions and really plan for potentially a 30-year retirement. So congratulations, Matt.
Thank you. And then, for all of you, just another tool that we have to help better serve you. So good for all.
Yeah, good job. Good job. So, okay, many of you might be like this guy here, just kind of wondering what is going on. There's so many moving parts to the year. There's market volatility, there's inflation, there's talks about recession, there's talks rising interest rates that's happening in real time. And so with all these things going on, there's just a lot of uncertainty in the world. And that's why we wanted to put this event on, to just educate you and empower you and show you what's happening, and more importantly, what to do about it.
Well, we did have a great 3-year run in the stock market. So 2019, we saw stocks up 31.5%, bonds were up 8.7%. In 2020, stocks were up 18.4%, and bonds were up 7.5%. 2021, stocks up 28.7%, and bonds were down just a little bit at down 1.5%. So what we're seeing is that things have changed, and we're all definitely feeling it. We're seeing a lot of uncertainty, such as the Fed raising interest rates, COVID, which is still among us. We've got midterm elections coming up. Inflation at its highest it's been in 40 years. We've got high stock valuations, and then geopolitical concerns. And so the market doesn't like uncertainty, and in the short term, it makes things very unpredictable, and that's what's causing the volatility.
Yeah, no doubt.
So the issue isn't that it's bad right now. The issue really is that we got used to a really good stock market the last 3 years, but in reality, we were just spoiled. If you look at it, this was the 8th best 3-year period in history. It's more than doubled the average from 1926 to 2021.
Right. And, Matt, what's so ironic to me about this is the 8th best 3-year period in history, which culminated at the end of last year, happened. Think about what happened in the midst of that 3-year period. We had a global pandemic, the likes of which we haven't seen in 100 years. So here, we had the pandemic of 2020, we had the bear market of 2020, we had a divisive election. That was smack in the middle of this 3-year period. And yet the stock market was very resilient. It rebounded. It had a wonderful 3-year period. And it just goes to show you that it's so unpredictable. You can't time it or forecast it, because the market zigs when you think it's going to zag. But kind of ironic to me that we've had just such a good period here.
Right.
And so, unfortunately, this year, as we know, is anything but good. In fact, it's a sea of red out there. And what we're looking at is U.S. stocks year to date down 20%, which is the classic definition of a bear market. We've got international stocks down about 20. We've got emerging market stocks down. We've got global real estate down about 20. Heck, even the bonds are down this year, down about 10. Global bonds down a little bit less. And so there's nowhere to hide this year. So after a really good 3-year run, everybody's really kind of feeling it this year.
Mm-hmm. Yeah. And so I just want to point out a couple of things here. What we're looking at are the number of trading days each year that had a plus or minus 2% day. So if you're not feeling good about things right now, it's definitely understandable. but you've been lulled to sleep. And what I mean by that is that over the last decade, other than 2020 and the fourth quarter in 2020 or 2018, volatility really hasn't been around. It's been low. So the volatility that we're experiencing today is actually pretty normal, and we're just not used to it.
Yeah, no kidding. Because I mean, in reality, when you look back to 1980, every single year we average at least a 10% decline or more annually. And Matt, I think you're so right that we've been spoiled a little bit. We've been lulled to sleep, like you said. We've had a period of years where we've had low volatility. But when we look back over the last 40 years, what we're experiencing now is actually really, really normal. It's par for the course, as they say. So yes, we're in a bear market, and the classic definition of a bear market is the market retreating or going down 20% from its all-time high, which we reached in early January of this year. We've had 13 other bear markets since World War II, so this is the 14th bear market. And on average, the market goes down about 30%, and it usually takes about a year to find the bottom. So it takes roughly 12 months. And then once finding the bottom, it takes on average another 2 years to recover. So if I guess the good news here is that since the market peaked in January, we're about halfway through on average. And at one point, S&P was down about 23-24%. So we're getting close, but again, you can't predict it. Every one of these things is different. But statistically speaking, we're about halfway there, which is good. I think what makes this particular period unusually challenging is that the bonds are getting impacted or affected. And usually bonds act as the buffer or the shock absorber in your portfolio. And this year, bonds are actually down at the same time stocks are down. Usually bonds go up when stocks go down. And in fact, one might argue that the bond market actually has caused what's going on in the stock market, as the Federal Reserve has been increasing interest rates, and we'll talk about that in a minute. Federal Reserve is increasing rates to combat inflation. The bonds have gone down, and so I think we have to acknowledge that this has been a rough period for bonds, and really a rough 2-year period. The good news here is we've been through this before. And when the bond market has experienced other 2-year periods similar to this, typically it responds pretty well the following 2 years after that. So, this is the good news here is that while bonds have been beat up a little bit, it has happened before. And then on the go forward 2-year time period, returns were pretty good.
Right. And some of you do have bonds in your portfolio, and you might be thinking, oh, maybe this is a time that we should get out of them. And we would recommend that you stay the course, because just like Brad said, the bonds, they typically have great returns the following years. So we would never want any of you making changes to the overall asset allocation unless your goals and values have changed. But even if the goals and values have changed at this moment, we would still recommend to not make any changes until the market eventually recovers, as history shows, and then we can talk about making those changes at that point.
Well, Matt, when the bonds do finally recover as we work through this rising interest rate period, the good news is that bonds are going to actually start to pay something again, and they really haven't for a long time. So
right.
The rising interest rate environment ultimately is going to help bonds.
So Brad, if you didn't think there's any more bad news, to add insult to injury, not only have the investments gone down, but the cost of everything that people are purchasing has gone up. So this is just brutal. We saw just a couple of days ago that inflation is hovering around 9.1%, which is high. But I want to remind everybody that the Fed is really adamant about targeting a long-term inflation rate of about 2%. And so like we've talked about, and we'll talk further, just the rising of interest rates is a necessity.
Yeah.
And so as you can see here, inflation has affected everything that you buy a little differently. And the things that you're buying, we can all feel it, are getting more expensive. I want to point everyone to the yellow boxes there. That's the broad category price change. But if we dive a little deeper and you look under the hood, that's the pink box, you'll see that even though the yellow, the broad market may not seem that bad, some of the things that we all purchase are getting hit pretty hard with inflation. So like lodging away from home is up 23.9%. Meat, fish, poultry, and eggs up 12.5. Hospital and related services up 3.3. Renting vehicles up 36%. Tuition is on the relatively low side, up 2.3.
Hey, and that's good news. I
Yeah, right.
I got 4 kids to put through school, so keep that tuition lower.
That's right. That's right. And then women's dresses up 8%. Sporting vehicles are up 7.8, and then gifts up 9%. So, so what can you do to help fight this? Well, staying invested in your stocks is the right thing to do. It's been proven to be one of the best inflation hedges, time tested. So just staying invested is the right thing to do.
Yeah. So of course, we all know that interest rates are rising, and when you look back at what happened, so we had the COVID, we had the pandemic of 2020, and the big concern in 2020 was that in 22 trading days, the market went down 34%. It was the fastest decline in the bear market territory in history. We went into a recession almost immediately. Unemployment went to double digits. And so the Fed was left with the really tricky challenge of how do they prop up the economy? And so what they did is they pumped a ton of money, a ton of fiscal stimulus into the economy, and it worked. Things did really well. I think arguably in hindsight, they should have put their maybe just eased up on the accelerator or the gas pedal in 2021. They didn't, and they weren't sure if we were out of the woods or not. Looking back, we were. And so now they found, there's all this money that's been pumped into the system, and people, what do? They're at home, they're working from home, they've got more time on their hands, they're buying stuff. And couple that with supply chain issues, and now inflation becomes a real problem. And the Fed didn't really think it was going to be the real deal. They thought it would be transient. Turns out that inflation is real. As Matt said, it's the highest inflationary rate in 40 years. And so now the Fed has to use the tool in the tool chest to combat higher inflation, which is increase interest rates and really tighten monetary supply. You see, the Fed, they have 2 main jobs. Number 1 is to keep employment stable, and number 2 is to keep prices stable. Well, they're doing a good job on the employment because we're at generational lows when it comes to unemployment. Plenty of people have work, or all those that want to work basically have jobs. And because they've got jobs, they've got money and they're spending it. And that's really what's driving this inflation, that coupled with some of the stimulus that was pumped in. And so now the Fed is really putting they're tapping the brakes here because they don't want prices to surge out of control. And so as interest rates go up, I'll give you an example of how this plays out in the real world. We saw that mortgage interest rates, they were in the low 2s, the mid to low 2s for a few years there, and they now have spiked into the 6s. And so what that's done to the housing market is it's starting to slow down the appreciation of the housing market. We haven't seen major declines yet, but at some point in time, that's probably coming. And that's what the Fed's trying to do, is just slow down the rate of increase because the cost of everything we've been buying has gotten higher. So for those of you that locked in long-term debt over the last 2 years, congratulations, probably locked in generationally low interest rates that we may never see again in our lives. And for those of you that don't have any debt, even better, but just kind of it's interesting to see how this is playing out. So with all of the uncertainty, there's now talk of recession. And a recession is defined as 2 quarters of economic contraction, where the gross domestic product doesn't expand for 2 quarters. And you're hearing this. And now I think the challenging environment is that we all have smartphones, and so we all get information overload. And so the drumbeat of recession is what we're hearing a lot. And so you've seen this before, but I don't know where you're at today in terms of the cycle of emotions. But as markets go up, right, those are good times, and we might be feeling optimistic, excited, elated, maybe at the end of 2021, you were starting to feel elated. Well, we really view this, Matt and I view this as when the general populace is elated, that's really the greatest potential risk. When everybody's feeling good about things, that's when we should look around and take stock and ask ourselves, what's really going on here? And then, of course, as markets go down, people get concerned and nervous and alarmed and sometimes downright frightened. And I don't know where you're at on this continuum of emotions, but Matt and I see when more people are frightened, history and the data certainly shows that this really is the greatest potential opportunity. So again, not sure where you're at on the cycle, but if you are feeling frightened or alarmed or concerned, typically this tends to end up being a good time for opportunity. We'll show you what we mean here in a second.
Yeah, that's perfect, Brad. Like we saw on the previous slide, when emotion gets involved, people tend to make poor decisions. Definitely not anyone on this webinar.
That's right. Been coached well.
Right. But some people, they try to do market timing strategies. They may want to change their asset allocation or even go to cash. And so the good news is that historically speaking, when we see a lot of cash on the sidelines, like we're currently seeing today, this is followed by good returns in the stock market. And so what we're looking at on the left side is assets sitting on the sideline at their near peak. So January 03, January 09, and then today. And so again, all of you smart investors wouldn't be sitting on cash because we know what typically follows. So if we look at the right side, the average rate of return of the stock market for the 3 years after money market assets have hit their high for their peak. So from 03 to 06, it's like getting 16.4% rate of return year after year after year. And then from 09 to 2012, 19.2 year after year after year. So very good rates of return. And so we're pretty excited to see what happens next.
Yeah, no doubt. No doubt. So in other words, when people are feeling the lousiest, oftentimes the stock market tends to do really well. And let me show you what I mean here. We'll take you back to, sentiment in the early part of this year was as low, not quite as low as the 08, 09 time period, but sentiment this year was really, really low. And it's still pretty low right now. And historically speaking, when you look back, when less than 34% of the country is happy or satisfied, the stock market tends to do really well, averaging 15.2% per year when less than 34% of the country is happy. Conversely, when more than 50% of the country is happy, or fat, dumb, and happy, the market, it's positive, but it's certainly not as good as when people are dissatisfied. So maybe another way of saying that is when people have negative views on the country, the markets, the economy, that's actually a contrarian indicator. And following those periods, the market does tend to rebound pretty well.
Yeah, that's great. And so what can we do and what should we be doing? You're probably starting to get the theme over here, but it is stay invested and let the market work itself out. I mean, what I'm saying is typically the deeper the decline, the further the advance. So the market responds very positively after negative events. And so what we're looking at here are a bunch of bear market timeframes. So the 87 bear market, the market was down 33.5%. And then it came back the next 12 months up 21.4. The tech bubble back in 2000 to 2002, market was down 49. And then over the next 12 months was up 33.7%. The financial crisis seems like it wasn't too long ago, but 07 to 09, down 56.8%, came back the next 12 months up 68.6%. And then COVID, the big sell-off in 2020 was down 33.8% and then came back up 77.8% in the next 12 months. So I'm just saying that when the market does come back, it happens very quickly and we don't want to miss out on any of those opportunities.
Yeah.
And so the other thing, although it is hard, to stay the course sometimes when emotion does take over and you never know what thing is going to trigger you. It may never happen, but it might happen. But I want to remind you that good things do come in bad markets. And so I want to start by looking at the right side of the slide here. And what we're looking at is the growth of $10,000 over the last 30 years from 92 to 2021. If you stayed fully invested, you 20x'd your money. It went from $10,000 up to $208,215 just by staying invested.
And that's phenomenal returns.
Right. And so it gets wild. If you miss just 10 of the best trading days over the last 30 years, you reduced your gain to almost half of that. And if you miss 20 days of the last 30 years, you saw a 73% less return. And then finally, if you miss 30 days, that's one day a year for the last 30 years, you saw a reduction of 83%. So I just wanted to go over that first, because if you look at the left side of the slide here, you'll notice that in the blue shaded pie chart that 50% of those best days happen in bear markets. And that's exactly the scenario and market environment that we're in. So I'm saying it again, that staying invested, because we don't want to miss those best trading days throughout a 30-year time horizon.
And it's so tempting to see people time and time again, want to get cute with it and try to go to cash. The good news is I think people have been working with this long enough and they know that that just doesn't work out well. But I think the statistics really back it up, and the data really shows us why this doesn't work. So fortunately, all of you have been very calm about this. You're students of the game. You've been around long enough, but really good points, Matt. And I think, the other piece of good news here is while bonds are not performing as we want them to this year, bonds have never had a negative 4-year time period. So there's even in the darkest of days and the worst of times, bonds have never been negative over 4 years. And so at some point when we work through this cycle of rising interest rates and inflation starts to get tamed a little bit and we start to settle in, the bonds are going to go back to doing what they do, which is they act as the buffer and the shock absorber in your portfolio. So this too shall pass in the bond market. And how much longer do we have to go? No one knows for sure, but good to know that it's never been negative for 4 years.
Absolutely.
But no doubt about it, for a balanced portfolio of stocks and bonds, because the bonds have been down this year, this has been a rough start to a balanced portfolio. Now, everybody out there you have a custom portfolio that's unique to your goals, to your financial plan, to your risk tolerance. So we're picking on kind of a standardized portfolio, but you all have custom portfolios. But I'd want to point out that a balanced portfolio, it's off to a rough start relative to history. And so we've had worse starts. We've been here before, but wanted to point out that there was some years that were actually far worse than what we're experiencing right now. And so we wanted to know, well, of those really bad starts to a balanced portfolio for the year, how did things turn out for that type of portfolio down the road? And what we saw was actually really interesting. So we looked at a 5-year period. So periods of time that started off bad. We only have had four negative 5-year periods. That's interesting. And when you look at them, the 30s, and they're in 1941. So that's Great Depression and World War II. There's only been 4. And we don't think we're anywhere near the circumstances we were in the 30s, the 20s and 30s. The economic backdrop we are in such better shape today than we were back then. So there was only 4 negative 5-year periods, but we wanted to look further. What about 10-year periods? And we saw that there has never been a negative 10-year period. In fact, you start to look at some of the returns over 10 years. And again, these were those periods that started off really bad. And 10 years later, all of them had some very, very positive returns. And then we took it one step further and we wanted to look at the worst. Mind you, we're looking at the worst 20-year periods here. There is not anybody on this webinar who wouldn't love any one of these 20-year periods, even though it may have gotten off to a really bad start over 1 year, and even maybe perhaps over 5 years. The 10-year numbers and certainly the 20-year numbers are fantastic. And Matt and I have heard this argument all the time. well, I don't have a 20-year time period. We would argue that not only do you have at least one 20-year time period in you, you may have two 20-year time periods because people are living longer and longer. In fact, your financial plan, when Matt and I we're pushing your life expectancy out to age 100. And some people thank us for it, that. Some people get mad at us for doing that. We don't control
Remember, we don't control that. This is just what we need to assume.
Yeah, but as your planners, statistically, our job is to make sure that your money gets there should you last that long. And so we would argue that everybody on this webinar has one or two 20-year periods. And the great news here is that even in the worst 20-year periods, the returns are more than adequate to get you to make your financial plan come to life. So it's good to look back and kind of understand that.
Yeah, all of those are such great points, Brad. We do see negative returns in the short term, but this is the fee, the volatility that you have to pay to receive those wonderful long-term returns that you're looking for. And so, speaking of fees, I just wanted to show this slide again. I know we've showed it before, just to show everyone that the average do-it-yourself investor underperforms the broad equity market by nearly 4%. And then also underperforms the aggregate bond market by nearly 5% because they're acting on emotion. They don't have someone to work with. So all of these things are just reason and great that you have a financial plan in place and have an advisor that you're working with. So all wonderful tools that you have exposed to.
Yeah. And so, of course, as we kind of we take a look at where we're at globally, backed by popular demand. This is the Skittles chart, as we like to look at it. And a couple of really interesting stories to tell here. The first one is that what we're looking at here is the last 10 years of performance of all the asset classes in your portfolio. And you have exposure to most of these asset classes, not every single one, but most of them. And really interesting here is we started off the 2011, 12, 13, 14 period. Real estate was doing well. Back in the early 20-teens, I guess, as you'd say. And then as we finished this decade, let's take a look at that top performer. It was large U.S. companies and big U.S. companies really finished strong. And as Matt mentioned, was really the eighth best 3-year period for big U.S. companies in history. And so as we finished out the last 10 years, big U.S. companies finished in first place over that decade. And the irony here is that we'll take you back 10 years before, a little bit more than 10 years. It was at the end of the 2000 to 2009 decade where big U.S. companies were in dead last place. Mm-hmm. They had lost 1% per year for an entire decade. And I remember some of you were saying, hey, we're going to sell these big U.S. companies, right? They're losers. They're these things have lost me money for 10 years. It's a dead old story, dead news. U.S. is over. And in fact, the number one performing asset class in that time period was the emerging markets, this yellow box down here. And it's not because we could predict the future or forecast anything. And as I tell you, my crystal ball broke years ago.
I've been working on putting it back together for the last couple of years. No success.
Matt has been trying very hard to put that crystal ball back together. And I wish that we could take claim for projecting the future. The truth is no one can. But what we were telling you 10 years ago was do not sell your big US companies. Things ebb and they flow. They're still wonderful companies, but things ebb and flow. And so for anybody that wanted to sell the US companies 10 years ago, they would have missed out on the number one performing asset class of the most recent 10-year period. And anybody that wanted to, worse yet, sell those US companies and load up on the hot performer in the decade before, which was emerging markets, look at how well that would have played out for you. It would not have been pretty. And so if there's anybody out there today that's saying, oh gosh, the international investments, I mean, yeah, 4%, 4.5%, emerging markets, less than 2%. This is for a 10-year period. If you're thinking, yeah, let's ditch those things, eventually, so mark my words, with the crystal ball being broken and shattered, those asset classes will come back because the US large cap, which has outperformed over the last decade, that outperformance will not go on forever. just like the emerging markets' current underperformance and the international investments underperformance, that will not go on forever. And you're seeing that the US dollar is really strong right now. And that's really more than partially to do with why the international investments haven't been as strong. But things ebb and they flow, and the US dollar will not always be as strong as it is today. And eventually that will be the wind in the sails of the international investments. What I want to show you, though, is this white box in the far right column there. This is a balanced portfolio that is not too risky, but just giving you plenty of growth, enough growth to make your financial plan come to life. And you notice that it's not in first place. It's certainly not in last. And it's right in the middle, kind of on the upper side of the middle. And I want to take you on the journey that a balanced portfolio would have taken you on. Going back to 2011, again, you notice it's always kind of somewhere in the middle. It's never in first place. It's never in dead last place. And what we want to do each and every year, and what we do is we take the top performing asset class or asset classes, and we analyze them to determine, do you have too much of those asset classes in there because of good performance? And what we do is we redeploy those, and we look at what is the bottom performing asset class, what's underrepresented in your portfolio, and that's called rebalancing. And that systematic, disciplined approach to rebalancing, while not fun, because it's forcing you to sell from the thing that's the winner, and it's forcing you to buy into the thing that's the perceived loser. But that systematic, disciplined approach, that's what pays off over time.
And takes the emotion out of investing, which we saw earlier, that does not help your investment experience.
Absolutely. So, what we're going through is it's not fun, but it's not unprecedented by any stretch of the imagination. We've been here before. And as we pointed out, we always point out, every single one of these that you go through, it's caused by a different thing. And so what's causing this one is high inflation. And so now we have to raise interest rates to slow things down. And okay, so that's the cause of the bear market of 2022. But all 14 of these things have been caused by very, very different circumstances. And yet, if you maintain that systematic, disciplined approach, you'll come out the other side. You'll come through this much stronger for it. But in any case, it's a pleasure and an honor to serve you. And we wanted to just take this time to shed light on what is happening and some of the things that we're doing for you behind the scenes. And with that, we would like to open it up for questions. Any questions out there?
It looks like we have one. Brad, you said earlier that bond prices go down when interest rates go up. Why is that?
Good question. Okay, good question. Look at it like this. So I've got little kids, little girls, and they love the teeter-totter. In fact, we have a teeter-totter at the house, and look at the relationship between interest rates and bond prices as that teeter-totter. In fact, I'll draw it out here on the screen. And what happens is, over here, I'll put an I for interest rates. And over here, I'll put a P for price. And so as interest rates rise or go up, it pushes bond prices down. In other words, when interest rates increase, bond prices go down. Why is that? Okay, think of it like this in practical real world terms. Let's say you own a bond of Coca-Cola, and it's paying you 3% interest because interest rates have been so low for the last 14 years. And now all of a sudden, with the 10-year treasury trading at around 3%, other companies, in order to seek your capital, have to give you a little bit better interest rate than the risk-free 3% of the 10-year treasury. So let's say that Coca-Cola's competitor, Pepsi, wants to issue some bonds. Well, to be competitive in the marketplace in a higher interest rate environment because rates have gone up, Pepsi has to issue bonds that say 5%. So what am I going to do? I own Coca-Cola at 3, but down the street, Pepsi's going to give me 5% of my money. I'm going to sell the Coca-Cola bond, and I'm going to walk down the street and I'm going to buy the Pepsi bond paying me 5%. And anytime a large group of people are selling an asset class, selling it's supply and demand, prices go down when a whole bunch of people are putting selling pressure on it. So as interest rates rise, bond prices will go down. So we anticipate that the Federal Reserve is not done increasing interest rates. They're taking their job very seriously. They want to keep prices stable, and that is their job. And we should all they're doing what they need to do, albeit arguably perhaps a little bit late. They were behind the curve, no doubt. But they're raising rates. They're not done. We're not out of the woods yet, but we will get to a point in time where interest rates are higher, and bond owners and savers will once again be rewarded for owning bonds, and down the road money market for savers. So this is a natural process that we do need to work through. And I think the good news is when we get out the other side, bonds will be paying something decent again.
Mm-hmm. I've got one here, and I'll take this one, Brad. I think it piggybacks on one of the topics I went over. It says, what do you recommend for people who are 65 years old if they should stay in the market or move it to less risky investments? This is a great question. And you may want to reevaluate your risk tolerance to see, because you're transitioning to a new stage of life, or maybe your goals or values have changed. All of these would be reasons that you may want to make a change to a less risky investment portfolio. What we're recommending, not necessarily, we don't know the full picture for you, but maybe don't make changes until the market stabilizes itself, because we wouldn't want you to sell investments while they're down. It doesn't feel good now while we're going through this, but just waiting it out, and then at the moment when it stabilizes and starts recovering, to reevaluate if you should be less risky at that point.
Yeah.
One more, Brad. It says, since we have not had the washout yet, is it wise to be in 60% bonds or other fixed income until mid-2023?
Matt, do you think that not having the washout, do you think that is that indicating that the markets has further to fall? Is that, you think, what's meant by that?
Yeah, I think so.
Yeah. I mean, I think that we've just seen time and time again. I think the most important thing is having a financial plan in place. And then I think having an asset allocation or a mix of investments that's lined up to make the plan come to life, and that's in alignment with your risk tolerance. And I wouldn't try to time it. And so I think having 60% in bonds, without knowing the financial plan for sure, it's hard to say, but that could be a little conservative for someone who's wanting to stretch their capital over a 30-year period here in retirement. So you can't time it. You can't time it. And so if having 60% bonds, I just think that might be a little too conservative. What do you think, Matt?
Yeah, I agree. So if you have excess cash on the side now, i.e. the money market chart, how would you invest it today?
Oh, that's a good one. All right, I guess it depends, right? I mean, it depends on how old you are. If you were younger, I'd say, boy, what's been hit the hard? Load up on some small caps and international small caps. That certainly have been hit hard. I really think you do need to know exactly what's the right asset allocation to bring your plan to life. And I would be looking at some of the equities that have been hit the hardest. And we don't like individual stocks. That's a great way to make a lot of money, but also lose a lot of money or potentially lose all of your money. So we'd rather see you in mutual funds, or better yet, exchange traded funds, because they're lower in cost and they trade for free. And that diversification is really going to protect you through markets like this. So you could purchase some asset classes that are on sale. And it's funny, Matt, I think investing in the stock market's the only place where you can buy a quality thing. If it's on sale 30%, people get nervous and want to sell it when it goes on sale. And everywhere else in our lives, if you told me, hey, the clothing store is having a 30% off sale, we go, that's a pretty good deal. Let's go buy some stuff.
Right.
So I like the way you're thinking, though. Yeah. Look for the asset classes that are on sale the most.
Okay, so I'll take this one. It says, when do you suggest rebalancing since we are entering into a bear market? another great question. For a do-it-yourselfer, if you're doing it on your own, I would recommend minimum at least once a year. Pick a date on the calendar and say, this is the day I'm going to rebalance. The way that we look at it, the real answer is on a needs-based approach. We look at your asset allocation, the relationship of stocks and bonds, and if any of those drift, if 2% or more, that's our trigger to rebalance. So if stocks go up 2% higher than where it should be, and bonds go down 2% lower, we'll sell the stocks and purchase the bonds. But really, we're looking in underneath the hood of just stocks and bonds. And if any of your asset classes within the portfolio drift, we're making those changes at that point too.
Yeah. Here's a good one. If a person was contemplating retiring this year, would you recommend they do that, or would you wait until the market and inflation is clearly on the mend? That's a brilliant question. And my answer is it really depends. And it depends on a lot of factors, and I'll lay those factors out. Number one, are you miserable? How miserable are you in your job situation? I think we got to start there. Number two, do you have a financial plan in place that shows you exactly what you need to do in order to not outlive your money over potentially a 30-year retirement? Or in other words, put it another way, do you have enough resources saved to where you can retire? And you need to be able to quantify that. And, it comes down to your peace of mind of, okay, what makes you feel more peaceful? Retiring now and transitioning into retirement and putting that job and that career behind you, and then enjoying, having every day be like Saturday where you've got every day off. Or on the flip side, you may be the kind of person who appreciates the security of that steady paycheck and hey, maybe work's not too bad. Maybe you can stomach another 6 to 12 months type thing and just let things in the economy and the market stabilize a bit. So I think it really is a personalized question, and just comes down to how much longer can you stand to work? And but yeah, if you could stomach another 6 to 12 months of working, certainly not a bad concept to just see how things play out. We certainly don't anticipate this being as bad as 2008 or 1973, 74. The economic backdrop is much different and much stronger than those time periods. But if you have the luxury of a job that you don't mind going to every day, I don't think it would hurt you to hang in there a little bit longer.
Yeah, and just one thing to keep in mind on that as well is that if you need to tap into your investment portfolio or not, because if you do, you may run into a situation called sequence of return risk, meaning that the market is going down while you're taking dollars out. It substantially increases the dollar amount that you have left for retirement.
Right. And good point, Matt, and kind of piggybacking on that, really, we've looked at this time and time again, and one of the best sources of income for retirees is Social Security. And if you haven't started taking your Social Security benefit, every year that you wait, it's actually every month to be technically correct, but on an annualized basis, your Social Security benefit is increasing by 8% per year, and that's guaranteed by the taxing ability of the U.S. government. So good points, Matt. Sequence of return risk, maybe you do work that extra year, delay Social Security another year, get the 8% return on your money for another year before retiring and then taking Social Security.
Cool. I've got one. So 12 months versus 6 months in savings now. CFP 101 will tell you 3 to 6 months of an emergency fund. So like Brad was saying earlier, really a individualized question. 12 months is on the conservative side. We do see some people doing that, and it can pay off. We know that money markets you're not getting much interest on cash in the bank, but that could actually help you. If that gives you peace of mind and allows you to wait out your investments and not make any poor decisions there by having 12 months of cash, that could be a reason to have that much in place in cash assets.
Yeah, no doubt. No doubt. Okay, there's some other good questions. Someone's asking about dividend paying companies performing relative to the market. I think they're doing fantastic. I don't have the data, the most updated data on our dividend payers outperforming, but by and large, dividend paying companies, in fact, there's a point where you looked at the yield on the S&P 500 at one point, and it was better than the 10-year treasury. And of course, that's changed now. The 10-year treasury's gone back up over 3%. But we love dividend paying companies. I'll get data on relative performance versus the broad market. That's a good question. I know earlier this year they were doing just fine.
Oh, so Social Security question came in, and I just read something a couple days ago. The question is, do you see Social Security going up more than 8% this coming year? Crazy to think about, but the cost of living adjustment that they're talking about right now is about 10.5%. So it may or may not happen, but they are targeting a large cost of living increase, which is the highest it's been. I don't remember the year, but it's been a while since it's been that high.
Yeah. All right. Well, with that, we are going to wrap this up. Fantastic. We weren't able to get to all of your questions, but we tried to get to as many as we could there. Great questions. And as always, it's a pleasure and an honor to serve you and work with you. And if you have questions or concerns or simply want to talk, that's what we're here for. We love journeying with you and being your partners in this together. And just wish you all a fantastic summer. And we'll be in touch. We're getting ready for fourth quarter tax planning for many of you, which is going to be right around the corner. Hard to believe that we're midway through the year already, and we're starting to think about 2023. Wild how fast.
And if any of you had a question we didn't get to or didn't get answered, feel free to email us individually. We can get that taken care of.
Yeah, you bet. Our pleasure. All right, guys. Have a fantastic evening.
All right.
All right, take care. Bye-bye.